Hi, fellow traders. This is Larry Williams with a special presentation for Stockcharts.com. You know, they say that an old dog shouldn't chase new cars, and I haven't been doing that. Bitcoin is a new car out on the streets. But can an old dog teach new tricks? Well, they say you can't learn new tricks, but I think I can teach you some new tricks about Bitcoin, gold, and the stock market today. Those are the subjects I'll be covering. So, ready? Let's go find out. The gold bugs, has been a term around a long time. Well, with the exact same thing has happened with Bitcoin. The Bitcoin fever is the same thing as the gold bug fever. They have so much in common. Let me talk about that. First of all, both gold and Bitcoin crowd distrust the Fed. They think that gold or Bitcoin is a cure or protection from inflation, and the privacy, that's a fundamental right. So they want to own gold, they want to own Bitcoin, and these two crowds really have a great deal in common. Now, what's happened is gold is different than Bitcoin, though, for a big reason. Both traders believe in a libertarian ideology. That's what fits Bitcoin. That's what fits gold. But gold has a real commercial value. It is used for things. Bitcoin, so far, well, you can't go down to McDonald's and buy a hamburger with Bitcoin. So it has become more of an emotional trading vehicle. But yet it is driven by some fundamental facts I'm really excited to share with you today. But I think when we think about Bitcoin and gold, there's some difference in them, but they're really driven by the same group, that Bitcoin or gold bug, if you will. Now we have the Bitcoin bug out there, right? So I'm going to try to explain what's really driving this market to you today. First of all, there is a relationship between Bitcoin, that's what you see in the black line, and gold, that's what you see in the red line. Notice they, actually this year, have really moved together. Again, that's because both groups have the same ideology about libertarianism, about what's going to protect them from inflation. They have top and bottom usually at the same time. They're not quite the same instrument, but they're similar. And because of that, we can get some good value from it. Now, recently, gold has been much stronger than Bitcoin, which is an interesting point because it would suggest that there's more volume or buying coming into gold and less into Bitcoin, a potential sign of weakness. And we look at the relationship even closer here now on the daily basis. You can see exactly what I'm talking about. Bitcoin has been stalling out while gold has been making new highs. That's a word of caution about the Bitcoin market, and there's more to come. We can also look at a valuation of Bitcoin on my valuation index. And here we're looking at the dollar index. And it's really interesting when we see we're at levels of overvaluation. Bitcoin does have a relationship to the dollar still. And as you can see, when it's undervalued, we get good rallies in this market. And when it's overvalued, we tend to get tops in the marketplace. So while it is an emotional market, there are still some real strong underpinning markets that do relate to Bitcoin. And of course, I'm using GBTC here, the Grayscale Bitcoin Trust, but it moves exactly like the rest of the Bitcoins. They all move together. So there's, I think, like a 82 or 87% correlation of any of the Bitcoins versus GBTC. So if you're a Bitcoin trader and you're trading Ethereum or whatever, don't worry about it. They all top and bottom at just about the same time. So we can even go a daily valuation. Of course, you can do this in stockcharts.com. Those are charts I'm using right now. When we're undervalued, rallied to the dollar index, wow, look what happened. Oh, a big rally up on the market. Undervalued here, undervalued. Oh, recently, look what happened. Just a few days ago, we got overvalued and Bitcoin has started to come down. So if you're looking for a fundamental measure of when to be more cautious or more optimistic about Bitcoin, this old dog is teaching you a new trick here. It's an old index we've used for a long time, my valuation index. It's maybe 30 years old now, but it has definitely application to Bitcoin. Here's a really interesting chart. There's also a strong relationship between bonds and the Bitcoin. The red line is the bond market, but I flipped it upside down. In other words, it's inverted. And look how the two markets follow each other, which means if you think bonds are going to rally, Bitcoin's going to come down. This is a rally in the bond market, a rally in the bond market, and Bitcoin came down. Rally in the bond market, not much happened here. As bond market declines, just remember the scale's flipped upside down. Bitcoin rallied. Big decline in the bond market, big rally in Bitcoin. Big decline in the bond market in red. Remember, this scale is flipped upside down. Big rally in Bitcoin. So you can key off of what you think is going to happen in the bond market as an indication of what's going to happen in Bitcoin. Just remember, you need to flip that scale upside down because they have an inverse relationship here. When bonds rally, as we see, Bitcoin has usually declined, something that traders will definitely want to keep in mind. There's another big negative in the market, and that's M2. This is money supply. Well, a really interesting relationship here. Big rally in Bitcoin. Well, look what was happening to money supply. Then money supply contracted a great deal. Look at that. And oh my gosh, Bitcoin came down. The recent big rally we've been in Bitcoin, well, look what's happening to money supply. So if you're a long-term or even intermediate-term player in the Bitcoin market, you'd really want to pay attention to M2 as a precursor of what may happen in Bitcoin as a longer-term trend measure of it. If you start to see M2 roll over and we start to see a decline in money supply, I think the bet is Bitcoin will also come down. Now, if those who've studied my work know I really like cycles, and I've used cycles a lot here, and I've done a lot of work with cycles on Bitcoin, and they're negative at this point. The blue cycle wave, it's not much of a cycle, it is a wave. We've seen this about 9 times in the past, and 83% of the time prices declined during this time frame when we're in this wave. The red line that you see is a shorter term cycle in the marketplace. And I've just highlighted in blue the longer term cycle. Here you see it in gray, and you can see how closely Bitcoin has followed that line. So this suggests to me that we're going to see a decline in Bitcoin until end of January, 1st of February. Again, cycles aren't precise to the day, but they're telling us generally that we should have expected a rally here, flat point here, rally, and now we should expect a decline until after the first of the year. So from this old dog's point of view, it's a time to start looking for short sales or protecting your profits in Bitcoin. If we look at the trend, now this is a day late, but we've already broken this trend line. So we see that the trend has started to change in this market as well. Another indication when I like to see a fundamental setup on cycles or money supply, and then I see a trend change. Oh yeah, okay, the trend is now acknowledging the fundamental condition that we saw. That gives me the opportunity to take a bias in the market, a directional bias, because trend is now in agreement with what I believe to be the fundamental condition of the marketplace. Well, look past patterns from the past. The last time we did a Stockcharts presentation, I showed a lot of markets and what I expected they would do based on what I called patterns of the past. So let's take a look at that. Let's see how those patterns from the past did. This is the patterns from the past from our March video of what we expected to take place in the stock market itself. This was the pattern. This is exactly from the presentation in March. We expected the market to work higher like this. Now, how did that turn out? Well, this is where we did the March seminar, and you can see our March video, and you can see what happened. We generally followed that pattern from the past. We also looked at that in Google. Here's a pattern from the past for Google. And we're saying, well, this is what I predicted should take place last March when we did our Stockcharts presentation. How closely did we follow that pattern from the past? Well, that's where it was when we did it, and you can see what's taken place. So pretty much it's followed it, turned up in this last little rally here. So these patterns from the past can be a really good value. Here's Nvidia, the big one that everybody's following, right? And the patterns is a bit of a rally, a really good buying opportunity in July, and a rally up. Well, what actually happened? Let's take a look. This is where our forecast was, a buy the 1st of July, I'm sorry, right in here, and the big rally, and then we start to roll over a little bit. Well, there it is. So these patterns from the past can be helpful. Here's the Tesla. Tesla was an interesting one because it looked like we should bounce up, pull back, bounce up again. That was a forecast made last March at this point in time right here. And this is what happened. The big up, big down, big up, and the big up we're seeing now. Not as perfect forecast, but a pretty good idea of what's going to happen in the future. Now, in a moment, I'm going to update what's happening with this forecast, and I want you to pay particular attention to that. We're going to leave stocks for a moment here, though, and go to the gold market. James Dines was the original gold bug. A friend of mine passed away a few years ago, but he was a guy that really kicked off being a gold bug. He acknowledged it, and I think he coined the phrase. And now we have Bitcoin bugs. But a tip of the hat to James Dines because he was the original gold bug. Debated with Jim, lectured with him, interesting person. So here's my take on gold at this time. First of all, we see the seasonal pattern in blue. We typically start to go down about now into the first or second week of December. Usually, this market starts to decline. If we look at the green line, this is our advisory sentiment. This is the most bullish a couple of weeks ago that gold had been, well, for a long time. And typically, when we get very bullish, it goes sideways or it goes down. When nobody wants to buy gold, like back here, perfect buy point. Nobody wanted to buy gold. That was the ultimate buy point to buy it. Even this trading range pattern, very low sentiment. None of the advisors were saying go buy gold. Yeah, actually, that's what you wanted to do. So this concerns me that we've seen an abundance of public sentiment bullish on the gold market, because typically that means gold's going to decline. But there's something more important I'd like to share with you today. The users and producers of gold are what we know as the commercials. These people who mine gold, these are people that use gold for computer chips or for jewelry, for whatever. And we can look at their trading or their investments on the red line right here in the commitment trader report. When they're getting out of the market, that red line is declining. When they're buying the market, the red line is increasing. They're adding to the long position. Notice they bought the decline, and then a big rally, they exited their position. They had a huge position down here, and here at the top, they got out of it. We're going back now quite a while to 2022. But here's the interesting point. Ooh, pay up. Listen, look at this. Open interest is the black line. When open interest is substantially rising, the public is heavily buying gold, or the funds, but the professionals, the commercials, were getting out of the market. That's what makes market tops. Same thing here. Big increase in open interest, but the commercials were getting out of the market. That's what makes market tops. You can see that again over here. Big rally, but the commercials are selling the rally. Open interest increases a lot right here, market top. Same thing here. Open interest picks up a great deal, the highest open interest we've seen for 7, 8, 10 months. And the commercials were exiting, and that makes for the market peak. So really important pattern. This is not technical analysis. This is what drives markets, the commercials. They're the users and producers, and we can contrast or compare them by looking at open interest about what the funds and the public is doing. So when you see a big increase, or look at the other way around, open interest coming down, so the public and the funds are getting out of the market. They're not buyers, but the commercials were. Who was smarter, not buying or buying? Well, pretty simple, right? So where are we now? Let's take a look. This is where we are right now. We're seeing the same pattern, big increase in open interest, and the commercials have been getting out of the market. Just the reverse of what we saw over here. Notice this entire rally, commercial bought. And now they've started drifting. Doesn't mean too much until we see open interest go to that extreme. And that's what I think is going to set up gold for a decline in this marketplace. We've seen a lot of, let's call it unsophisticated money, buying, getting net long. Open interest is the total number of contracts open. They've been opened by the public and the funds, but the commercials, the users and producers, have not been doing that. They were heavy buyers back here, and we had a nice rally. Well, look where they moved. They moved over to the sell side now. At the same time, the public has gotten aggressively bullish in the market. So that to me is a really caution about further extension of prices in the gold market. Then, of course, you know me, I like to look at cycles. Now, you probably like to look at the cycles with me. This has been the most dominant gold cycle, and you can see, well, And it's pretty clear where we are right now. I mean, cycles can be wrong, but they're usually a good way to bet. You can see it's been pretty decent, a buy point here, buy point here, buy point here, here. Now, this doesn't mean that because we go down like this, it's the bear market, just like you could say, oh, we should expect the bear market from here to here. No, the way to read cycles is simply this. This would be a suggested high, suggested low, suggested high, suggested low, suggested high, suggested low. Don't get too carried away with the magnitude of the cycle. Suggested low, suggested high. Next suggested low coming in the earlier part of 2026. So it doesn't mean we're going to follow this path down that much. Don't get carried away with that. Just think right now cycles are negative on an intermediate to longer term basis until sometime into next year. But for now, we've seen the action of the commercials, the users and producers, when we've seen what happens in the cycle. So I think that's a negative for gold market now. The best cycle in this market on a long-term basis has been the 8-year cycle for gold. It's been really strong, dominant. You can see it here in the blue line. It too is saying we should continue down. Again, it's not going to call to the exact day. Don't expect that much from cycles. People expect too much from all of their indicators, not just cycles, from any indicator. There's a general path of what should happen. That general path has been pretty darn good. I expect it will hold up the same way in the future. Okay, let's turn our attention to the New York Stock Exchange. Time to look at stocks. Where are we going? What's next, huh? Well, here's the Nasdaq. Remember, I showed that projection of the patterns from the past we did? Well, this is that pattern, and it suggests now we come down. That's the same pattern we saw earlier in this presentation, same pattern we saw last March. They did such a good job of predicting this rally, now suggests we come to the downside. The S&P 500, same pattern, great on the upside. It suggests weakness in the market. Now, again, that doesn't mean we have a major decline in the market. It just says we can experience some weakness in this market. The magnitude of the decline doesn't tell us how of the indicator how big or bad it will be in the stock market itself. But certainly it's a reason to have some caution here. If we look at the Dow Jones, we see the same thing. Oh, yeah, we go higher, but for right now, we should experience some weakness in the market. And again, pretty good pattern, not precise, but it's certainly an indication. What I hope to do here is give you kind of an X-ray view, an insight into the market that you just don't get from trend lines. You don't get it from percent R, Bollinger Bands, or MACD. Those are just things that reflect the past. They're not predictive of the future. And here we can get a pretty good idea of the future. The big thing going on in the S&P right now, this is what is significant, is there's been a 255-day cycle in the S&Ps. Look at buy point, buy point, buy point, buy point, buy point, buy point, sell area, sell area, sell area, sell area. Not much happened. Sell area went sideways until we took off. Oh, and of course the sell area up here. Pretty good forecast that we should be aware of in the future. You're probably wondering and ask, hey, Larry, where's that now? Let me show you. This is where we are right here, right now. We are in the weak part of the cycle. Now, again, there's a cycle peak. Does the market crash? A pretty hard hit, but there's no assurance we're going to go down this much. It's just we run into problems from here to, next spring up in the market. Start to run into solid. We actually rallied for quite a bit here. Then we have the decline, the next spring up. So the next really buy comes, it looked like around the first of the year. So as I see it in here, we've had a great run in the market. It's probably time for some profit taking. Do I expect this big of a decline, what it looks like in cycles? No. I expect some pullback in this market. And I do think we will have a year-end rally. In terms of 2026, oh my gosh, all year long I've been working on my forecast for 2026. As those who subscribe to it know, we're very bullish in 2025, said we will be in a bull market. Buy all the weakness you can, expect higher prices. And well, you've seen what's happened in 2025. There's weakness. We said middle to the latter part of March. That's over here. I want to be a buyer. We'll nail the 2025 forecast. Is pretty good. I'm working on the 2026 forecast. It looks like we're going to have some weakness and then a buy point, but more on that later in the year. So stocks are also overvalued. We can look at my valuation measure of the stock market. Also, we can use bonds, you can use gold, but this is where we are right now. We're overvalued. Typically, when we've been overvalued, look what happens. The overvalued reading has been pretty good in this market. Overvalued, boom, down we come. Overvalued, overvalued. So this is another fundamental reason, not technical, but it's suggestion from the relationship of bonds to stocks that stocks have run too far, too fast relative to what the bond market has done. Oh my gosh, I saw this just yesterday. Ray Dalio. We're heading into very, very dark times. He pointed out an 80-year cycle that suggests an area of significant global and internal strife to upon us. Well, I think the cycle guy, years ago, I roomed with Ray briefly in New York City. So we've been aware of each other for a long time. I don't think he knows cycles. Well, maybe he does. I don't know, but I think I know him a little bit. So that 80-year cycle. I never heard of an 80-year cycle before. I got to go look at that. So I did. First of all, you had an 80-year cycle. In the last 160 years, we've only seen two cycles. So we don't have a whole lot of appearances of the cycle, but we can go all the way back if we want to 1863. The red line is the 80-year cycle that scares Ray Dalio. Well, price went sideways. And here's the 40-year cycle in blue. We get more of those, but not much happened there either. Then we come, and the next time we saw it was 1946. Now the red cycle should peak out in here, bottoms over here. Well, it basically went sideways. The 40-year cycle, pretty good at calling the decline in 1946, and the bottom, but it kind of waffled around a little bit. But certainly there was no debacle, no 1929 or 1970 type of bear market in stocks. This is what the 80-year cycle is showing for now, for whatever it's worth. And again, we've only seen it twice before. In the history of stock price, a little tough to draw a conclusion from it, but it suggests that we should have some weakness in here. But if we look at the past examples to draw the conclusion that Ray did, significant global internal strife, I'm not so certain of that. Not at all. So bottom line here, expect some weakness in the market. No bear market yet, at least. We're going to talk about that for 2026. But certainly, I don't think that's going to happen this time. But you see my cycle works is suggestive of declines coming in gold, in Bitcoin, and some type of pullback here in the stock market. So prepare yourself for that. Yeah, I'm not always right in the market, but I've held up most of these predictions you've seen. You go back and watch the Stockchart.com video. They've been pretty precise over the years. So I think it is a time to have some caution in the market. Cycles got us here. They did pretty well. In Montana, where I grew up, you dance with who you brought to the dance. We brought cycles to the dance, and the music's been pretty good. So I think we need to pay attention to these at this point. Well, that kind of wraps it up. I'd like to thank you for watching and Stockcharts.com for producing, because without Stockcharts.com, you wouldn't be seeing any of this. Or for Louise, my wife, who's also made this possible by helping me in getting this produced. So a great big thanks to you for watching, for following my work over the years. Really appreciate that. It means a lot. So thank you. And again, thanks Stockcharts.com. So until next time, as always, you got it. Larry Williams wishing you good luck and good trading.